Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for November 24th, 2012, Thanksgiving weekend edition. The market has worked its way back up into bull volatile. It's at 54 on 100 on the annual RSI, the weekly RSI 14. So we're looking at an annual basis there. On the 10-day NDX, we're at 99 out of 100, so at the top end of overbought. Price relative to the 200-day moving average is red bullish at 2.72%, so we're only 0.75% away from sideways. Slope of the 50-day moving average is red bearish at 0.22%, negative 0.22%. ADX 21.4 degraded the bearish trend that had been developing with this week's gains. ATR percentage at 1.34 is volatile. No change to the blended monthly rebalancing portfolios. Next up around 1 December. In ETF2, the theoretical exposure is 70%. The model portfolio will be at 70% exposed. There are two positions that are being added this week: the emerging market bonds and international real estate index. The link goes to what will become a weekly feature, which is a trade of the week example of a typical trade from the chat room. That one was on Friday. It was the trade in the double leverage silver ETF intraday for 5R. Quick look at the ETF portfolios for blended monthly. Pardon my cough. It's everything global right now: Asia less Japan, Euro-Asia blend, and Australia. And then in the 26 ETF portfolio, it's China, gold, and the Euro 350. Market health check. Vertical blue lines are 10, 20, 30 days worth of look back. The horizontal purple line is the swing high at about 147.25. Blue river in the middle is the 30 period Bollinger Band. The red thin line is the 50-day moving average. Thick green line is a 10 period moving average. Black line in the middle is this slope of the 30 period regression line. The outer black lines are the regression channel formed by the maximum excursion from the regression line during the look back period, which was this latest penetration of the 200-day moving average earlier in the week. The blue channel is an extension of that graph regression channel carried forward, showing what should happen if none of the underlying qualities of the market change. You see a 5 and then a 10% pullback thresholds from the swing high. 0 to 5% would be classified as noise, 5 to 10 a correction in a bull. So we fought our way back out above the 200-day moving average, up back into the noise level. Friday's price action was significant because it started and closed outside of the RAF regression channel, so that's an indicator of a potential change in the underlying qualities of the market. So that means the top of the 30 period Bollinger Band here at 144 is in play, and then 147. Got to see a close above 147 to be a resumption of the bull. We have only 0.75% away from the sideways channel, and you can see this relentless upward march of the 200-day, but even the 200-day starting to roll over here based on the weakness of about the last 40 days. Overbought on a Williams %R basis. You can see the jaws of percent price oscillator have opened up, pointing upwards from Tuesday of last week. That big move. So bullish volatile. It had a nice bounce. Still a market in transition, trying to find itself after the election with increasing volatility and very close to important tactical decision points here at the 200-day moving average. So we'll find out what kind of a market we have here. ETF2 regional report, 3 out of the 10 are on a cash signal, so we're at 70% invested, 30% cash in the theoretical model. Bull volatile. EFA is better than SPY, 64 is better than 61, 69 on the strength rating is better than 60 on the in the S&P. Inside the U.S., it's large caps, mid caps, small caps, and then tech in terms of average scores. The two strongest sectors, IEV and Asia less Japan. The two weakest remain Latin America and Japan. World market model, anything Europe is working. All the large caps in the U.S. below average, mid caps above average, small caps generally below average. Australia and Hong Kong are the strength in Asia. Only Malaysia and China are lagging. Asia less Japan doing very well, I think, based a lot on Australia. Mexico leading the way, better than Canada, but Canada's in better shape than the U.S. Inside the business sectors, it looks more like the risk on trade, materials, energy, and finance at the expense of defensive plays like staples and utilities. What's odd in here, I think this is still the Apple effect with the U.S. tech lagging global tech, but tech is lagging behind the defensive sectors and also the basic business sectors of materials, energy, and finance. ETF top 30, little change from last week. Inside the Dow 30, it's Bank of America, J.P. Morgan, Travelers, Procter & Gamble, 3 out of the top 5 there, and then Home Depot continues to just march right along. Now up almost at 65. Hewlett-Packard continuing to lag behind. And Intel, Microsoft, AT&T, Alcoa, IBM near the bottom of the stack. So lagging in tech, strength in consumer staples and financials. The VIX has been responding to increased volatility, has an ATR percentage of 6.61%. This gives you an idea of excellent targets for intraday trading. We will leap ahead now to the daily. Okay, so let's take a look at the gap stat over the last 30 days. It's been a while since we've done that. Gap downs have happened 12 times out of the last 30 days, about evenly split between did the drop continue to fail. On days when it gapped down and failed, notice that follow through of minus 0.98%, hugely important, whereas the reversals are only 0.19%. So if you got almost a 5-to-1, you get better than a 5-to-1 payoff on looking for the collapse after gap downs. A gap up and reversal, the follow through has been 0.67 compared to 0.55 on the gap up and gain. So right now the gap downs, playing new lows of the day has been the lucrative way to play that. Short signals in tech and Latin America. You can see the volatility has flattened out a little bit after this run up out of the quiet period. This week's price action brought the bulls back up into parity with the bears on the ADX, and so the strength of the bearish trend has definitely rolled over. I've got a handful of symbols here that test out at better than 2-to-1 on the reward to risk. Max Payne candidates, Hewlett-Packard, Intel, Microsoft, Walmart, Disney, VIX, gold miners, Brazil, metals and mining and utilities in the ETF 100s. The winners have been, again, all the financials. Dow Tactical Summary, only one doji in JP Morgan, a washout pattern in Intel. And it also tests out at almost 3-to-1 on reward to risk on the auto framer, so that should be on your short list going forward. you can see really down here the strength in Home Depot, Cisco, Bank of America, really extraordinary strength compared to their peers, and just how bad Hewlett-Packard has been. ETF 30, one doji in Japan, and then we get the treasuries are showing an overreaction signal long, and also a 5-day down signal. So that's testing out at 6-to-1 reward to risk. So if we see any kind of profit taking next week based on this 5% bump in the S&P this week, treasuries are well postured for pattern trading. You can see the 30-period regression line and this very nice move from 135 to 141, just about a 5% move off the bottom here. And that brings the slope of the regression line back to its 10-day, and now it's making a crossover here at more than one standard deviation below the 6-month average. So what that says is you can continue to play the long side here. That is a signal of, that is a sufficient price action to indicate potential turning point after a significant downturn. So we've had over a 3 standard deviation move down, as you can see here. This was where it was the last time that it touched the 200-day moving average. So we've had a strong move up, big move down, and now a retest at 147 would not be surprising based on just based on regression technicals. The 30-period regression line has rolled over. The 10 has already left the station and gotten to the top of the regression channel. That's why I think the easier money has already been made, but it's still available. The 90 has just come back in that nice smooth sine wave. It's just come back to the 0 line. So we're right at a turning point here as it's come back to the middle of the river. Whether it can continue and just treat this as one big pullback on strength and actually have higher lows. So we have the makings here of another potential choppy up move. Has to get through 147, which would take it north of the river here, and then that would be an indication of good times ahead. Failures in here, though, can be shorted with targets at 135. You can see SPY is a little bit stronger than the move in the small caps. Treasuries had a nice bounce, have been making higher lows. So the treasuries with a 5-day down, still a good pattern. Gold has made a little regression line crossover and pointing up, found support at 165, whereas before it found its support around 155. So that's the gold move is still marching steadily upward. All right, that's the quick review of the reports. So it's still tactical trading time, and there's an equally strong argument to be made on either side, but there is room to the upside available here to get back to 147 on continued buying. So the early action on Monday should be instructive. So this is Ken Long from Tortoise Capital. Hope you're enjoying your Thanksgiving. Look around to your left and right. Remind those that you love them. You can't tell them too many times. So take good care, and we'll see you in the chat room and on the web next week.